I'm very excited about this one. This is going to be a good one. I'm very excited because of my knowledgeable panel.
No pressure, Amanda.
I've got that in my intro. Knowledgeable and experienced early stage panel. All right. Shall I just kick it off, do you think? Should we get going? I think if one more person joins, let's get to 60. Go. Come on. Yeah, I can do it. All right. Might as well start. All right. So welcome, everyone. This is our first Q&A of 2023. And for those of you I don't know, my name is Amanda Price. So I lead our high growth ventures team within KPMG, which is a dedicated startup team. We are very fortunate today to have an extremely knowledgeable and experienced early stage VC panel to discuss our topic, which is the investor outlook for 2023. So hello, Paul, who is the managing partner from Rampersand. I'm not going to say Paul's last name, and I've removed everyone's last name because I never say Paul's correctly. So we'll all just go by first name. Rachel, partner from Giant Leap. Hello. And Lou, managing partner from Sprint Ventures. So we're going to use the next 45 minutes to discuss some of the big predictions for 2023. Our intent is that you leave the session with some really key takeaways. So we're going to endeavour to dive into some of these as much as we can, and to be as honest as possible, although we are aware that some of the answers may not be the ones that you want to hear. Thanks also for everyone who sent through the sessions when they registered. We got so many. So what I've tried to do is bunch them together under the main topics in some as graceful fashion as possible, although it's a bit difficult sometimes. We want to be as interactive as possible. I'll just turn the chat on. So I keep an eye on the chat. So if you've got questions, keep them coming through so I can have a look at that, and I'll try and read them out as we go. And oh yeah, finally, I have to say this because I forget every single Q&A, and if I do, my team's going to kill me. If you have any questions or interested in discussing the topics further, please reach out to Fabio, who's our head of sales, or myself. Kelly will put the details in the chat. So that's it. Okay, we're ready to kick off. So get ready, panel. This is the state of play. So yesterday, just to do a bit of another promotional plug, we released our report, our Venture Pulse report, and some of the data showed that in 2022, we saw global venture capital fall basically I won't do the numbers, it's 32% decline, so pretty big decline globally. However, according to PitchBook, who does our reports, we recorded a US, it's a record actually for Australia, so US 5.84 billion invested into startups. We're up 2% from last year. So 32% globally, up 2% for us. So just to dive into that a bit, overall, there was a difference in deals by negative 18%. So we dropped in the number of deals by 18%. But in Q4, we dropped by 95%. I was reading an article yesterday. It said Michelle Decker said Australia was typically 2 quarters behind in global VC trends. So she expects investment levels to decline further. I'll use that as our prediction. So just really keen to get your thoughts. I'm just going to throw to you guys just your thoughts on what we saw in 2023 and what you think just at a high level is going to happen for 2022, happen in 2023. So Rachel, I might just start with you.
Sure. So I think we definitely saw valuations reduce dramatically in 2022 at the back end. And I think that's probably going to continue on in 2023. And then we also saw investors kind of just being a bit more cautious and risk averse, as we're seeing a lot in the media and founders are probably experiencing when they're chatting to investors. And I think that will continue for a while. There are a few things in the market that are indicating that there's still uncertainty about the future kind of economic prosperity of the market, and things like rate rises, etc., that are making people just a bit cautious. So there's still capital out there, but I think it's just a matter of kind of being aware that investors are just stepping back a little bit.
Yeah. And just on that, in terms of what we're reading in the press, which has, there's been quite divergent views as well. Like, some of it's been, well, this is going to be the 2023, will be a huge year for venture capital going forward. But some of them are saying it's very opposite. I'm just sort of, I don't know, it's just delving into that a bit more about what is actually happening. Because if you look at the S&P rating, like they came out saying we've got a AAA rating, Australia's not going to go into a recession. So is what we're hearing actually what's happening? Lou, do you want to comment on that a little bit before you go into your views?
Yeah, look, I think, Amanda, and I totally agree with Rachel, it is a bit of let's call it a two-speed economy in terms of the early stage, markets are still getting capitalization through various forms. We did 5 deals, for example, in December alone, which is in that sort of time when that back half of 2022, it really dropped off. So, but we're early stage investors. I think what we're seeing at that higher level is commentary around that latter stage into the M&A and IPO market. And that's that S&P type commentary at the public markets, rather than those early stage private markets. And but however, what happens there is it infects, I suppose, the confidence levels, and that's what we saw at the back half, and that's what Michelle's referring to, and is being reflected in those numbers in the back half of 2022, and that definitely has extended into 2023.
Yeah, Paul.
I'm going to try and add to that, maybe with a bit of a bull case, but not ignoring some of the warnings, which I agree with. Think about, like, obviously we're all in Australia, I think, is that right, Amanda? Or in this region, Australia, New Zealand, and largely early stage companies.
Yeah.
So how do we think about this market, and how might it be helpful for a founder to think about the market? I think, let's think about it from a supply and demand perspective. So I'm very bullish on Australia. We, Rampersand, are very bullish on Australia. We think this could be the golden era. Why do we say that? We've been investing in Australia for nearly 10 years, and this is really the first time what we've seen is, from a supply side, meaning the number of high quality startups is exponentially higher than it's ever been before. People with huge ambition, change the world, deliver a 10x better solution to whatever problem they're trying to solve, think big, think global. And so startups are now, I'd say, socially and professionally acceptable.
Yeah.
It's acceptable to start something. It's acceptable to join a startup early. It's acceptable to back a startup early. And that's, I'm not sure the age of the people on this call, but that's quite new in Australia. And it's matched by the, I won't say demand yet, but the quantity of high quality capital that's available as well. So we've got unprecedented numbers of high quality founders really looking to build amazing sustainable businesses, and an unprecedented amount of capital looking to invest. And that's really new for Australia, and that's exciting. That creates the opportunity. But because it's quite new, what we haven't lost, in my view, in Australia, despite the floods of capital over the last couple of years globally, is this kind of, we still got the soul of a bootstrappy startup. We haven't had oodles of capital in the past. We are stronger as we collectively, Australia typically, or stereotypically, have a strong bootstrappy muscle. And so in times of real capital injections, so the zero interest rate period, or the COVID period, as people calling it, maybe Australians struggle a little bit because we don't have that huge abundance mentality. And so we maybe don't go quite as hard and quite as unsustainably, and 400% growth without any care of the bottom line. Our culture is still to go for high growth, but do it in a sustainable way. So if we can match huge ambition, and I think the message that we need to be really careful with this downturn is not to lose the ambition. We still want big vision, big solution, big impact companies, but also don't lose our sustainable soul, which means maybe growing 200%, but a pathway to some kind of sustainability. So good unit economics as a vision. And I think relative to many other ecosystems who have been around for longer and have become really strong in high capital supply markets, we will do better. I think we've got a better muscle for that period. How long it lasts, I dare you to ask anyone to make a prediction. None of us know, but that is the bull case for Australia.
Do you think that's like when you look in the US, who sort of really fueled that capital intensive, like there was just so much capital out there and they're really going for those high growth companies. Is that, are you saying that that's maybe why we won't see such a massive drop off, because we weren't investing in that way? We were building more sustainable startups, and from that might, like, we might not see that real drop off because of that.
look, like every stereotype, they're generalizations. And so I should, the caveat to my previous comment is in individual cases, we will see, I suspect we'll see a lot of pain because there were plenty of companies that emulated, and for good reason, the high capital cost of growth models. And it takes sometimes, trial and error to figure out whether the capital was well spent. And there will be companies who, like in the normal course of events, maybe didn't use that capital to achieve, weren't able to achieve those milestones, or the nature of the business wasn't what we thought, and actually there is no pathway to profit here. It's all high burn, but that's universal, and that's venture capital is here to figure that out for some companies, and venture capital understands that not all of them are going to work. So yes, we'll see pain. Yes, companies will go under, and it will have some significant human impact. To want to acknowledge that. At the same time, that frees up talent, capital. We have not seen failure. This ecosystem hasn't seen failure, and we will. And without trying to be disrespectful or sort of ignore the fact that there will be people who suffer terribly, and our job as investors is to help them through that. As a macro trend, I think we will sort of on balance, on average, whatever you want to call it, have some really good winners as well.
Yeah, and I think with the talent piece too, when you have these markets that have been strong for so long. I remember when I was in the US and we were there with the startup and we hit the GFC, and what we saw through that is we were trying to hire salespeople, but all the people we were trying to hire all only sold through really great markets. Like no one had sold in a down market. And I think what that taught a lot of us, who we all thought we were amazing salespeople when the market was going up, was that we realized we didn't actually have those skills when you really had to create demand yourself. And so I think from a talent perspective, in a way, this can actually start teaching some of those skills too. It's a very different skill to sell when the market's down than what it is when the market's good. All right, we might get on to the big topic, which is always really around capital raising in this sort of market. So we're obviously out there talking to a lot of founders, and there's the questions we're getting the whole time is, will I be able to raise? Should we delay our raise? So just wanted to go into that a little bit before, and maybe we can also cover what investors are looking for. But I just thought too, I think we discussed the other day, it probably best to break, to get more specific, let's break this into pre-revenue and post-revenue. So maybe let's start with pre-revenue, and I might throw to you, Lou. So, from a pre-revenue company, will I be able to raise in 2023? What should I be thinking about?
Yes, and it's I'll put the pre-revenue hat on, the pre-seed, some call it, Amanda. I think it's still a very hot market in the pre-revenue industry in here in Australia. As I said, out of those 5 deals, 3 of those were pre-revenue for us, and a couple were post-revenue and really starting to grow. So, I think there's still massive opportunities. The message for everybody out there is there's massive opportunities to access capital in all the various forms that capital is. And we're VC on this call, and there's many different others. And, and I just want to comment again back on that point before. I had to do this after the .com crash. I had to do this after the GFC. I've done this. This is my 3rd cycle, and this is my 1st cycle as a VC investor. But
wow, you look so young. Wouldn't have guessed.
Thank you. So fresh. Yeah, thank you. It's there's a few battle scars, a few bloody nose and torn knees. But look, bootstrapping, friends and family, and most importantly, angel investors and those investors that sit just before the junction of venture. And I think venture certainly has a position to support, but venture is going to be way more cautious in that pre-seed, pre-revenue, round. And I think that angels are good. There's certain angels that we all know and recommend, of course, and talk to VCs about who we like to see on the cap tables as they come through. That's probably a good tip. In terms of the sophistication of the investor to get you to a chat with a VC at a pre-revenue stage. But look, if you're an amazing founder, you have a globally scalable opportunity, you have a high margin opportunity, and you've already started to build an amazing team around you, there's 3 or 4 core metrics that doesn't really matter what you're doing right now. We're looking at what's going to happen in the future. And that's when we're, cutting those early checks. I just would say, 2 final things about that. When you're looking at capital raising in the pre-revenue stage,
Could I just, no, it's him. Paul, I might get, do you want to, when you're looking at capital raising in that, go.
Yeah, don't do it. I think that's what Lou's saying. I have no idea where he was going. Lou's a very smart man, and I won't begin to try and predict. But I think the point you're calling out is, I think there were two. Lou's point was, and maybe Rachel, because this was something that you also have a view on, is like venture capital. Over the last 10 years, we've gone from no venture capital to, if I've got a business that's making a loss, then I should be raising venture capital. And it's sort of become a zero to everything. And I think that's become a bit clearer maybe over the last year or so. But just to share with the group, VC is not the answer to everything. In fact, it can be quite inappropriate for many businesses. And venture capital, I'll lose back if you want to finish your answer, Lou.
Sorry, I just had to change my internet connection. I had to go to a different connection, but I don't know where I got up to. But Paul, thank you. Can you hear me now? Is everything good now?
Yeah, all good.
Great. Look, I was just giving that real final. I'll just close that off. That pre-revenue chat. If you're raising capital, don't expect the world. Don't expect the largest checks, and don't expect checks that are expect checks that are going to be potentially tranched. So at the pre-revenue stage, and I don't know whether you got the message that we invest in, great founders, globally scalable, high margin businesses at that stage. So it's about finding those early checks and then talking to VC about helping them get to those next, revenue type rounds. So expect smaller checks and expect tranche-based incentive and milestone-based checks.
Right. Thank you. And Paul, you were just saying that before you sort of stopped around VC is not for everyone. I think that was quite interesting.
Yeah, and so as Lou was saying, there's other sources of capital. Venture capital, maybe to pick up on that tranching point, VC is sort of, it's to fund unnatural companies. And the VC in itself is sort of an unnatural. What does unnatural mean? It means you're going to have losses before you have profits, and they're probably for a period of time. But they are designed to create some value that couldn't be created naturally at speed. So maybe that's a bit of sort of bullshit bingo, but what it means is there has to be a reason to raise that money. That tranche, I don't like tranches. I'll come back to why, but I'll use that as milestones rather than tranches and say the purpose of this capital is to create the position, whether it's position in market, product capability, the data that you can acquire, some kind of differentiated, sustainable advantage over any competition or fast followers or incumbents that is then really valuable. And that might take one round, that might take several rounds. Typically, it takes several rounds of capital. And so thinking about, it's not just to stem your losses and pay your executives or to invest one moment in time for a product. It's around that sort of escape velocity kind of concept. And there are other ways to plug a short-term gap in your balance sheet or in your P&L. And Lou was talking, whether that's debt, whether that's credit cards, whether that's some friends and family, whether that's bank loan, whether pre-revenue, it's not easy, but this is a segue to a second point, which is not all VCs are the same either. So what's really important as you're thinking about venture capital is what is their model? Are they really playing the game of deploying lots of money? So bigger funds tend to have to deploy more money to get meaningful returns. Some of the smaller funds who focus early stage is really about, they're comfortable, they're really much more able to generate significant, let's call it meaningful returns for their fund without having to invest lots of money. So you've got a $50 million fund, just, simple maths, you've got a $50 million fund, you're looking to return $200 million to your investors. You can do that by owning 10% of a unicorn or, a few, you don't need a decacorn or a bunch of, generational companies. So thinking about what the VC actually wants out of that investment, is it a pathway to future checks? Is it a check that's meaningful for that fund? Do they intend or expect or want to follow on, or are they comfortable? Are they a bridge to another type of investor, or are they we'll be here forever, but you got to make sure you hit top percentile, or we sort of aren't that interested. So everyone from a founder perspective would encourage to think about, when you're looking at taking on venture capital, what are the VC's intentions and what are their requirements?
I think the other thing to mention here is just the overarching question of why are you raising, as to whether you raise now or raise in the future. If you're raising to survive, you don't really have much choice. And so, it's looking at, if you've already received investment, potentially looking at your existing investors to bridge the gap for a while, to maybe be able to demonstrate a bit more growth, to put you in a better position to raise further external capital. If you're raising to launch, maybe this isn't the right market for you to launch, because maybe customers are more challenging depending on the sector that you're in. And if you're raising to grow, I think that's another question as well. Are the customers there? Are you actually going to be able to grow? And if you pump more money in, will it lead to customers in this environment? So it depends on the sector as well. I think a lot of commentary is around the tech sector, which I think is not really a sector in and of itself that we can generalize. I think when we're an impact fund, so we look at areas like climate tech, which actually grew significantly in 2022. So basically there are reports saying that it grew 90% from 2021 because the planet's on fire or underwater, or lots of different things around the world are happening. So we're looking at New Zealand now and the floods, and hope everyone is okay over there, because it just is really, the world is calling out for change. And I think somewhere like climate tech, we won't see that reduction as much, and it could be a good time to raise if you're in that space. So I think the generalizations are what we need to do on a call like this, but also being mindful that there are nuances to be aware of.
Yeah, great. And okay, so if we just shift that now and we think again, think about I'm a post-revenue startup. We put that hat on. What am I thinking about? Will I be able to raise? Again, big general question. So Phil, go as specific as you like, but should I be raising 2023 or not? So Lou, do you want to start with you on that one?
Yes, and the answer is only if you need to. If you can build a business, and I've built 2 companies, and we never had venture capital, and we had to actually make a profit. This thing called profit, which is just incredible. That taught me that if you can get to a certain inflection point of a pathway to profitability without the need as a growth company, this is a post-revenue business, then, why dilute your cap table? So this is coming from a VC telling companies not to raise, right? But if you do need to raise, it's often for the reasons of governance and advisors, and it's for growth and access into different markets and having those amazing advisors to take you there. So the answer is yes, if you need to, but do it from the right investment partners, but also do it to extend as much runway as you can. I mean, the common goal, I suppose, is to raise at least 24 months runway in this sort of market. And we're seeing, really good founders show a pathway to profitability within 18 months or 24 months, to give a buffer of approximately 6 months within the cash flow forecasts. So, the answer is depends on your situation, but if you do need great partners behind you, and you do need to have that, that the continuation, as Paul said, of growth capital, then I would recommend that.
Okay, Paul, go the same order. Paul, you?
Oh, I'm just double muted. Trying to add to that. Throughout all the longitudinal studies of venture capital, this is sounds like a strange way to start the answer. So what matters in VC to generate returns, which by proxy is what matters for startups to be successful. Let's make it relevant to the audience, like for you. And the answer is timing. Timing is everything. We love to pride ourselves on the fact that we're amazing at understanding and assessing and supporting founders, and really understanding. And that's all important, of course it is, your fortitude and your vision and your commitment and resilience. But ultimately it's timing. So there has to be a reason to do what you do now. And the reason too often is, because I've just thought of it. There has to be a tailwind. There has to be something that's creating the major opportunity, which is generally a major problem that you can solve 10 times better than the incumbent or anyone else. Yeah, and that might be that there's now new technology that enables a better solution, or it might be some socio-economic shift or some societal shift has created this opportunity. So whatever that thing, like if you're, and I won't say businesses building off Chat GPT, but if you're the founders of Chat GPT, why now? Why now is because the technology is available. If you're talking about impact, like Rachel was saying, well, because the planet's about to be destroyed, and that's a pressing need. Through COVID, we've seen the rise of remote. So getting the timing right is critical, and part of that, as Lou was saying, is balancing the cost of capital. But if there's a compelling reason why now, then given, we've said before, there is quite a bit of capital around. If you're pre-revenue and you're trying to attract venture capital for the reasons that we've talked about of building a big, large, high impact and ultimately sustainable business, then that money should be available. It might not be easy to get. You might need to kiss a bunch of frogs. It might not be as cheap to get, as in the valuations will be lower, but it should be there. And just on the point of delaying, sorry.
Yeah, no, go.
Sorry. Who the hell knows what's going to happen? Next year may be way worse. In fact, I suspect it will be way worse. If we look at .com, it took 2 or 3 years for the market to hit bottom in private markets. Like, we might be we might be right now in the best position we're in for the next 2 or 3 years. Don't know.
Yeah. Cheery note to end on. Thank you, Paul. Rachel.
Over to you, Rach.
Rachel.
Yeah, well, I mean, Lou and Paul have covered, I think, what I also believe in terms of the nuances and thinking about kind of what you're raising for, who you're talking to in terms of investors, understanding the market around you. I think to be specific, and I know there were some questions around kind of metrics and things that we're looking for. I think it's just when people are kind of thinking about, are you targeting really high growth versus capital efficiency? I don't think there's necessarily a need for a trade-off. And so really thinking about things like your burn multiple. So that's your cash burn, your net cash burn. So how much are you eating into your bank balance over your net new annual recurring revenue. And so that's really thinking about, if you have a higher burn multiple, for every dollar of revenue, you're burning more to achieve more growth. And so if you're doing it, and they basically, they talk about what is good and what is bad in terms of metrics, you kind of want to be under 1. For that would be amazing. A bit above that, okay. And then, 3+, you're kind of in the dodgy realms, like 2, 3+, you're in the dodgy realms. And so when investors are thinking about these types of specific metrics, how much are you burning to actually grow? You're not trading off growth. If you're doing it efficiently, you could grow really, really significantly in this kind of market and raise capital if you're doing it efficiently. And so I think there's just this general talk about, should I delay my capital raising? Should I, what's the right time? Should I even raise capital? If you've got a good business, solid metrics, like Lou was saying, good founders, global market, there's no reason you shouldn't be able to raise now.
Great. Excellent. Okay, I like that positive note at the end. Paul, noted.
Just a counter.
Look, the next thing I think would be good just to delve into a bit is what investors are looking for. So what we're hearing is, we've moved from growth at all costs type mentality to the word capital efficiency, which we hear all the time. I'm just going to read out the questions that we've been asked so many times over the last, or the commentary we've heard over the last few weeks or months. Founders, I don't get what you want to see. Do you want to see growth? Do you want to see profitability? Do you want to see margin improvement? What do you want to see at the early stage so I can focus my efforts? So I think we're delving, Rachel, you started to touch on that. I think it would be really good to get into that and really understand what is capital efficiency? What does that actually mean when you are saying that to founders, Lou?
Yeah, this is how long's a piece of string?
Yeah, exactly. Oh, you're on mute, Lou.
I could answer this in many different ways, and there's so many ways to look at this. I think the biggest I'll separate this into pre-revenue and post-revenue. For us. Pre-revenue is we need to see some metrics, we need to see the opportunity, we need to see the global growth opportunity, and come to us with some purchase orders, come to us with some LOIs, letters of intent, come to with us with that whole market validation, the customer validation. They really like it, they really want it. And if we ring them and they say, and we ask them, look, if we took this away from you, this platform, this proof of concept, what would happen? And if they start crying on the phone, then we know that that's a really good pre-revenue opportunity. So, having customer validation proven up, they're the metrics at that really early stage. Surveys, LOIs, purchase orders, all of that sort of thing. When you get down to more of a growth and you're starting to do MRR, there's a certain pathway for us when we cut a growth check out of our growth fund. You need to sort of start to think about, there's a magic number for many VCs, and that's 1 mil ARR run rate. So that's $1 million, not actually you're doing $1 million at that moment, but you can actually locate in, say, 6 or 12 months in your cash flow forecast that your income's going to be, with your growth rate of 30% per month, you're going to hit 1 mil annualized recurring revenue. So that's a really important metric that if you're a growth company, you really sort of, and a lot of those founders are really working towards that at the moment. But certainly to your question, I wouldn't say profitability is there at all.
Okay. Paul, Rachel, anything to add to that one as well?
So Jenny, Rachel's number was 1-to-1, basically. $1 revenue to $1 of burn. Is that right, Rach?
Yeah, so 1 is great. Under 1's amazing, and then you just go from there. So.
And just for everyone here too, what we've recorded this. I'll do the notes and we will send it out. So, and I'll check with you guys before we send it out just to make sure we've got all the numbers right, just so everyone on the call, so you're not madly trying to write everything down, because I think there's a lot of good things sort of being discussed. But yeah, let's think about maybe, Paul, if we think about post revenue for that's question. So capital efficiency for a post revenue company at the moment is what? What are you looking for?
Yeah, look, probably Rachel's magic number is large, but let me go a bit macro for a minute. I think I feel viscerally the frustration that founders have. Is like, I speak to one investor, they want one thing. I speak to another investor, no one tells me the truth. They all just say I'm too early. What the hell does that mean? And I think it is a frustration, and why a lot of VCs do that is because there's something that they really like about what you're offering, but you haven't managed to convince them. They haven't got to high conviction on something. And sometimes it's as simple as they just don't want to work with you, or sometimes they don't care about the problem, or they don't feel they can add enough value, or they haven't got conviction on some degree of capability. And so it's really nuanced, and there isn't a perfect answer. We actually ban in our team saying you are never allowed. We're an early stage fund, so it sort of seems it's an easy give, but we never say it's too early. It's like, what is it? We might be wrong. Like we're wrong a lot of the time. Like our job is to be wrong a lot of the time, and that unfortunately includes missing great things. So whilst it's personal, don't take it personally. Every VC is looking for something a little bit nuanced, and it's really hard to put it into a formula. And there is no formula. And once there's a formula, that formula gets broken. To a huge extent, what we're looking for, whether you're pre-revenue or post-revenue, is people who can make shit up as they go and deal with it. Right? If you're not better at that than we are, there's a problem. So, people sort of misunderstand sometimes the lessons of the past. They go, well, whatever, Atlassian did it this way with no salespeople, so I'm going to do it that way with no salespeople. And Mike and Scott are on the record saying that's the wrong lesson. The lesson is we had to figure out a way to grow that was capital efficient and high impact, and no one had done it this way before, and we just sort of made it up. And that's kind of your job. So what are we looking for? The metrics around capital efficiency is around that one-to-one burn early, but we also accept when you're still building out your team, you're going to have higher burn. So that one-to-one typically kicks in maybe a little bit later when you've got sort of, let's say, a bit more meaningful revenue. Maybe you've gone through that million, but we want to see that you've got a sort of a pathway to get there. What we look for, and we split it, so timing, as I've talked about, and then we'll break down most broadly and say, like, we want to look at the technology, the product, and the commercial elements. So do you have, we're a tech investor, so we want to see that you can build amazing technology and that it's got some differentiation. The product is what uses that technology to solve the problem, and what are you able to do in terms of listening to your customer, delivering that solution, rapid learning and evolution and change and response. And the commercial is around understanding the power and the importance of distribution, and then some of the metrics that we can start to think about might kick in for that distribution model and that cost to service. And one of the things we use internally is that we call it hack the CAC, is it might cost a bit to acquire that customer, but then what does that pathway look for? Is it a one-off transaction and they're gone? Or once you've spent that investment acquiring them, what's your thought about what else you can sell them to grow your LTV, your lifetime value? So when you're very early, you have very few customers, very little traction, very little repeatability, but that's a pathway we're looking for. Once you've got a bit more traction, the kind of metrics we're looking for is your cost to acquire, as well as your retention rates. Sometimes that's really scary for early stage companies about retention. So just a nuance there is, as you're learning around your go-to-market, you will sell to the wrong customer and you will misprice it. And so don't be afraid, even in these troubling times, don't be afraid to let the wrong customers churn. And so as you're learning, one of the things we're really looking for is speed of learning and saying, well, actually what we learned here is, that agency was, we thought we had a hypothesis, we sold a bunch of agencies, guess what, they all churned. But what we learned was the actual end customer, which is the, whatever, CMO in a multinational who buys with a credit card swipe, they're really sticky. So our churn might look like 30%, but that's last year's targeting. We've evolved from there, and now we're actually getting real sticky retention. So sometimes the lesson that I think is misunderstood is say, well, we must have churn. We must get our churn under control. So it's all about revenue and retention. And whilst they're really, really important elements, don't misunderstand the nuance that lives within that. And once you've found a cohort that you can acquire relatively easily and actually retain and upsell. So we're looking for sort of 120% net retention plus, which means you start the year on $1 from a customer, and by the end of that year, you're at $1.20 because you've expanded. That's what we're really looking for once you've got some traction and once you're figuring out who are the right customers for you.
Yeah, that's great. I mean, that point about pricing is really interesting. We've got a woman in here, Sue Kong, who works with a number of our startups to look at the pricing models when companies go international, here and then internationally. She's saying to us that she thinks the majority of startups are underpricing the offering, which is just, I just think so. I just hadn't really thought about it. I thought it was so interesting because it's such a big lever, like a slight increase in pricing.
I think that's understating
Amanda,
it. It's all of them.
Yeah,
you will do.
Amanda, it's normally a confidence thing. And I would encourage all the founders out there to have confidence to price accordingly, and lean on VCs and people who've done pricing before, advisors, to really help you out before you get stuck in a position that maybe it's going to be very hard to increase in the future.
Yeah, and just I will go to the questions just because I'm seeing them coming through from the audience. So we'll do a rapid fire question, 5 minutes in a second. But Lou, when we were talking yesterday, one of the things you mentioned that I've got to be honest, I didn't really understand it, so I thought I might just throw it out there so you can explain it to me and to everyone else, which is you mentioned things, you were talking about a change in deal construction. So can you talk through, I'll let you talk through that. What did you mean by that?
Well, look, it all comes down to Yolanda and the AFR, Amanda. Yolanda is a great writer. And if you look at the first half of last year, there was a lot of priced rounds. And that means the lawyers are involved, basically, and doing, rounds that are actually pricing evaluation. The first half of last year, 2021, 2020, the back half of 2020, we saw a lot of news that was happening about price rounds. As soon as that May, June time came last year, I took a real interest in deal construction and how startups and scale-ups were going to actually raise in the market. And the word on the street and actually the opportunities that were coming through, and then reverse engineering it from the founders actually coming to us and coming to other VCs, was around what instruments were they using in the back half of 2022 and into 2023. And there was a bit of consensus around, the safe notes and the convertible notes became very, very hot and very active, and they still are. And there's two schools of thought there. There's one around they're being used to support companies that may, under the table, I call it, need capital to continue to be, propped up in some ways. But VC's patience will run out. LP's patience will run out. The portfolio construction of a VC fund is quite complex in terms of having produced TVPI and all the other, not just ROI, but all the other key metrics. And I think that founders have to be very aware about what's happening in the market and the type of instruments they're going to investors, especially VCs, with. I think price rounds we'll see more price rounds potentially in the back half of this year. Hopefully, to Paul's point earlier, the market does survive, and we are hopefully fairly bullish about the macro piece around the global economy, and that flows into Australia. To my point, I'm actually quite positive about the back half of this year. Let's hope, fingers crossed. But I think deal construction is a really important thing to consider. And I'll leave with one point. Not every VC wants lots and lots of safe notes on their portfolio construction. We do want to see price rounds. We want to see an uplift in terms of our valuation of our funds. We've got to respond to our investors as well. We've got to come back with an increase within our funds. And if you just keep doing safe notes all the time, it's not going to be good for either party.
Rachel, anything further to add on that one?
Well, I think the point here is around as well valuations and people wanting to just kick the can down the road for valuations, and why they're wanting to do more safes and convertible notes, and thinking about valuation caps, and thinking, if I'm not going to get the valuation I want today, maybe I can put a higher valuation in a note, and then maybe kick the can down the road and kind of deal with that a bit later. And I think that's why there's been a bit of a shift in towards safe notes and convertible notes. And so it's to say that that's not necessarily going to work out for people anymore. I think the priced rounds give investors certainty, and more investors are more risk averse nowadays, as a gross generalization, and so therefore looking for those price rounds. So I think the main piece there, in my view, is around the kind of valuation as to why there has been that kind of shift, and also speed to getting the transaction done, because typically there's not as much paperwork. So those things are things for founders to consider as really, how are you going to raise capital from investors in this market? What are they going to accept? And then you think about the acceptable instrument for them, noting valuation is a key part, and speed to transaction.
Actually, great. Okay. I might go to some of the questions. The first one was from Jeremy. So he talks about what's the prospect for medtech startups in this market. Now that might sort of broaden that out a bit and sort of say, it'd be good just to hear your view on your guys. I don't know what I'm talking about. Your view, the panel, on what industries that you're seeing. Obviously talk about medtech, but what do you think is going to be sort of the bigger industries for this year? Lou, I might throw to you for that.
Sure. Thanks, Amanda. Yeah, we invest in medtech and aged care tech, and there's a question from Julie. Hello, Julie. About aged care. We put medtech or health tech with aged care as well. One's medtech. I just want to refer to that one. A huge push since COVID. A massive, in the last couple of years, there's been some amazing innovation come out of a post-COVID world. There's been an aged care Royal Commission, like the Financial Services Royal Commission. So anything that flows through with additional federal government funding will always have thematic, a thematic that we can look at investing in. I do see medtech and health tech and aged care tech, to summarise that one, as a key part of the investment thesis of venture into 2023 and well beyond. And we're already doing that. We're already investing in a lot of those companies. AI and automation, of course, with the whole buzz of ChatGPT. 4 years ago, we actually set out to invest in AI and automation about productivity gains, increasing efficiencies, job creation, things like that. So health tech, med tech, AI and automation. And the third one for us is e-com finance, and then infrastructure tech is the fourth one. So, there's some really key macro trends that we've always invested in that are actually coming to the fore. So, but if you're not within those, don't think that you're not actually, being able to be located within, one VC fund like us. I think you can, we've got a company called Clipboard here in Sydney that basically we invested in. Some would call them an ed tech company. Some would call them an automation, a schools enablement company. Some would call them a curricular company. We invested in them because of the great founders and things like that. So, they're the core thematics for me at the moment.
Okay, great. Rachel, you talked before about climate tech, the increase in climate tech. When we look at Climate Salad, they break climate tech into 9 different segments. Within those segments, is there any particular segments within sort of climate tech or impact that you're seeing that sort of might come to the top in 2023?
Yeah, so it's actually, we're working on our Impact Startups benchmark report that we're going to release in the next kind of couple of months that really looks at the kind of breakdown of what we're seeing. But really, we're seeing about 50% of our deal flow coming into the sustainability theme that we have, and really looking at climate tech and breaking it down. The types of trends we're seeing are things like energy storage solutions that can kind of help with moving us to more renewable future, basically, and really thinking about things like demand response technology. So one of our companies, Amber Electric, allows basically access to the wholesale price for electricity for customers, retail customers at home. So really encouraging to use energy when it's cheap and renewable. And so demand response will automate that, and that's something they're working on as well, and really being able to ensure that consumption aligns with generation, so we don't have this kind of excess and that we're not reliant on unrenewable sources. And then decarbonisation, because the carbon emissions problem and greenhouse gases are just getting worse, and we need some way of extracting it from the atmosphere. And then also this circular economy. So thinking about so we're seeing things like red cycle shut down, plastics recycling is no longer possible. So how do we make sure that we've got sustainable solutions to minimise waste going to landfill? So companies like Great Wrap in our portfolio that creates, compostable cling wrap that basically is used from potato starch, that you can use home wrap and pallet wrap that is compostable. Those types of solutions are really compelling because we're trying to solve these big problems, and there are still investors like Giant Leap who have capital to invest in these areas and want to invest now because this is the decade that we need to act. And so there is a lot of opportunity for climate tech startups, and particularly those types of areas.
Right. And Paul, what's Rampersand focusing on for 2023?
So the way we're structured is 3 cores, 2 around business model, which I'll explain, and then emerging frontiers. So we're really strong in marketplaces and business software. They're 2 core pillars, but also I think probably like everyone, and Lou mentioned it, AI and automation has been a thesis of ours for some time. As a seed fund, it's really important. We're always exploring. So we have this 4th pillar we call emerging frontiers, and every one of our investors is constantly thinking about what are the big problems, what are the big evolutions in technology, what are the big things that we should be investing in that might create a $1 billion type company. So if I think about where our team's focused and exploring at the moment, I've got a pretty strong quantum thesis. Australia has a very strong quantum ecosystem. We've got 1 investment there, and now looking at quantum apps. Broad brushstrokes. So Rachel's more expert than I am, but sustainability is clearly a timely issue, and also I think the question started with med. We're breaking down med health and sustainability of humans is a clear issue. If we think about we just come out of COVID, but the real pandemics are things like obesity, aging population, and so there's a lot of nuance to health and med, and I distinguish between the two. We don't do bio, we don't do medical devices. Heavily regulated environments are very difficult. So I'd say we're erring on the side of digital health as an area of exploration for us. But as Lou said, one of the things about being an early stage investor is we don't know what's coming next. And it's one of the exciting things about this. So if you go, oh, I don't see myself in any of those categories. If you're in a category, you go, well, actually, I hate all this categorization. Why do I have to fit squarely into a box? It's a fair point. And the reason we do that is because we don't want to be mugs just throwing darts at a board. We want to have a very intentional investment thesis. And it helps us to develop our lens and our ability to assess and add value, because ultimately, as one of the questions is, VCs, I think, thankfully, have gone beyond the point of just dumb money. I think there has to be something that we can do to understand, to unlock value for you. So if we're just spray and pray, it's really hard to do that. In the market's just gone by, you can sort of get money from anywhere. Maybe spray and pray will come back in vogue because money is just less available, so you'll be able to get into deals. But I think the VCs pride themselves on having focus areas and the ability to actually unlock some value for founders. So there has to be some degree of focus and some degree of efficiency when there's hundreds and hundreds and hundreds of opportunities to go through, understanding what you do. So so if you're in a situation, you go, I don't know what category I fit in, or it's a new category, or and there aren't any VCs talking about it, that might mean might mean you need to do a bit more work and figure out actually you are in this, you're just resisting categorization, and that's pride and that's fair. But maybe if you want an efficient sales process for raising capital, think about where you might fit. Or it might be it's a really new and interesting emerging space, and you will potentially have to do some education of your potential investors, but that could be a really exciting space as well. So don't give up at that point either.
Okay, great. Quick one, Lou, I'll throw to you from Ed. How are pre-revenue companies being valued? Are convertible notes more common? You might have touched on some of that before, but quickly.
Yeah, exactly. Yeah, look, yes, safe votes, convertible notes are sort of seem to be out there. Convertible notes with some other instruments within them about offering up an interest rate, and that often, that's what we're seeing at the moment, rather than just a standard Y Combinator safe note. Look, I think the valuations are about comparables. I think just don't sort of do a thumb suck and say this is what we're going to be worth at the next round, which is what a safe note normally suggests. Actually sort of say this is what we're going to get to for you, and this is how we're going to realize our valuation, and we're very confident. Here's our three-way cash flow forecast, and here's our sophistication of the business model to help us get there. You're more likely to have an open conversation.
Great. Okay, thank you. Good answer. Paul, quick one from Mark. I'd love to know how you sort a lead versus follow for later round. Example, large B. Finding a lead versus follow seems a whole extra journey.
It is, and I don't think we have. It's some of our more advanced companies. We're having exactly this conversation. What's the advice that we're both giving and hearing? It's really hard at that later stage. That's exactly the part of the market that's been smashed, because the last couple of years they've probably been paying too much, like overvaluing companies, so they're a bit underwater. Their investors are pretty annoyed with them. So the analogy is, if you've just told your kids to, you just busted them with the hand in the cookie jar, and then you turn around and they got the hand back in the cookie jar, you're going to be double as angry. So they're really wary of, and they don't know where pricing settles, and that's why lead is so important. Lead sets price and sets confidence in that round. And maybe in the past we've been able to say, hey, here's a sort of a subset of funds who are more prone to leading, and therefore, and I'm talking globally. If there's not so many choices in Australia, but globally, if you're a startup that has sort of global intent, then the capital markets are open to you. But that particular part of the market's really tough right now, and the advice we're giving and getting is you just got to have a lot of conversations, because it's very, very hard to tell. It's a shitty answer, but it is the truth. It's very hard to tell who's deploying and who's leading.
Yeah. There's one actually, it's quite an interesting one from our very own Matt Herring. So in the current market, how are you evolving as VCs? How are you evolving how you work with startups, and particularly as the VC market becomes more crowded? So I might go to Rachel. Oh, and also just it says talking about, do you need a point of difference? So I think there's sort of two questions in that, really around, you know, different market. How are you working with startups, and then talking about point of difference, really.
Yeah, so in this market, I think there's a lot of, I guess, making sure that we're available for whatever our portfolio companies need. That was always the case, but I think there are more challenges popping up for various different companies and in different ways. And so just being really available for our founders to call us whenever they need is something that we're really focused on. And we are meeting with, you know, a huge number of new founders as well, and basically trying to help them with advice on what the capital raising landscape looks like. So I think it's more about being, I guess, responsive and being able to help with those kinds of questions, because the nature of the questions that we're being asked has changed. And so I think that has changed the way that we operate. Fundamentally, though, in terms of foundational support that we provide, you know, it's always the same things that we can do, you know, talent, introductions to customers, introductions to more investors to help them on their capital raising journey. Those types of areas a lot of us look at. And then the differentiation piece for Giant Leap, it's easy for us because we're an impact-focused VC. We still target the same returns as traditional VCs, so we can help in all the commercial areas. But our point of difference is also helping in areas like impact measurement and management, how to really create that narrative and that story. And we've got a lot of resources online as well that you can jump on and have a look at to really share the impact that you're creating, because a lot of even employees, etc., are looking at how they can join a purpose-driven company. So being able to be clear with that messaging is really important. And then also the DEI aspect. So we're really focused on supporting women-led businesses and diverse teams. And so we've actually released our DEI policy publicly, so people can actually look at how they might set up their own DEI policy to be able to attract more diverse talent into their teams as well from a startup perspective. So, you know, we know that diverse teams outperform, and that's something we think that can provide resilience for startups in this time.
Excellent. Lou?
I just might add to that. It's for us, there's a couple of comments. One is around being there at all times, at all levels of the organisation. So we offer, you know, that real experiential capital, social capital, and more importantly in this market, network capital. And I think having LPs and investors that actually can be the first customer, or, you know, a growth customer for an actual portfolio company is really important. And the second point I'd really like to make is I would encourage any founders out there that are looking at any VCs or, you know, sophisticated investors to actually call up the other portfolio companies and just sort of see what level of support they provide. And that's a really good referee check. And I'm sure everybody on the call here, you'll get great response about Rampersand and Giant Leap and of course Sprint. So I think the big thing there is do your checks. It's a two-way street. You're going into a relationship for, you know, potentially 3, 5, 7 years. And so really make sure you do your homework as well. And don't be afraid to, you know, just check in to see whether the VC is actually doing what they say they're doing when they're pitching to you.
And as always, Paul, the last word.
Such enthusiasm. We Rampersand have always had a view that it's more than money, and despite the fact we entered the market when there was little money, it's all about the experience. We think about, so yes, Matthew, good question. The market's got busy. How do you differentiate? And we're all building platforms, all building brands that mean, you know, stand for our ambition and wanting to back amazing founders. Now some funds have got track record, both from a financial performance and but as Lou and Rachel both from supporting the founders. We just did a piece of research with a whole range of founders from pre-seed through to unicorns, not our portfolio, just across the ecosystem. And we asked the unicorns, what did you expect and what did you get from your VCs? The answer was, we expected a whole lot. What we got promised, but what was really valuable. So they didn't look for functional support, and didn't want their recruiting wasn't as good as they claimed, or their marketing support wasn't as good as they claimed. But that one relationship I had, that was really important. And when I had a down moment, they were there, or when I just had that perfect introduction at the right time. So we can build platforms, and we do focus heavily on doing that. But ultimately, it's about recruiting amazing people. We recruit triple threats, we call them, which are people who are really attractive for founders to want to talk to because they've got a lot of experience. So the triple threat from our side, just to be clear, is that they can attract great founders. They know what great looks like, so they're assessing really well. But most fundamentally, they're there to assist. And that becomes a virtuous cycle. And so now most of the VCs have been around for a little while. You can assess whether they're good to their word on that.
Yeah, excellent. I think that's about it. Sorry if we didn't get through to any of the questions. I will endeavour to answer those and put those back into the notes. But thank you. Huge thanks, Lou, Paul, Rachel. That was excellent. Really appreciate it. See you later. Thank you.
Thank you
Thanks.
all.
Thank you.
Well done, Amanda.
Cheers.
See you.
Thanks, guys. Thanks, audience. Bye.